Ready to elevate your credit understanding and score? With insider tips and a plan, you can take action to improving your score, which can save thousands in unnecessary finance charges. Let's tackle today's topic with your coach, Credit Christy.
Hey friends, it's Christy, your credit coach. Thank you so much for joining me for another episode. Today, let's talk about something invisible but expensive, the cost of money. Not your payment, not your budget, the actual price tag tagged on to what you borrow. A car, a house, the balance on a credit card. And right now, we're watching a big policy idea that could rewrite the rules of money in America, for good and bad. Buckle up, Buttercup, here we go. So in this first part, I want to talk about a reality check on a car loan. See, what you pay in interest isn't necessarily that interest rate that helps dictate your monthly payment. So you've got your interest rate, your term. Is it a 60-month term? Is it a 72-month term? And then, of course, the dollar amount that you're borrowing. Well, let's say that you're going to finance a $40,000 car purchase. On a 60-month loan at about 7%, your monthly payment is $792. And on a 72-month, it's $682. But here's where a lot of people don't get. Even though the interest rate could be exactly the same, the extra 12 months to help reduce your payment by $110 a month, well, that just added more than $1,500 in interest. So that longer term feels easier, but the longer term costs more. And that's how interest eats up wealth. Now, let's talk about a 30-year mortgage. A few weeks back, the 50-year mortgage was it was sensationalized. It was in every conversation I was having, people seeing it on social media and on the news about the potential of a 50-year mortgage. And I did an episode on that. So if you would like to know more about it, dive into that one from a month or two ago. But let's do a reality check in 60 seconds or less on a 30-year mortgage. So let's say you're borrowing $400,000 and it's at, let's make up a 6.25% interest rate over a term of 30 years. Now that principal and interest portion of your monthly payment is $2,462. Got it. But that interest over time, that equals $486,000. You heard that right. You're paying more in interest than what you've borrowed if you pay your mortgage on the first of every month perfectly on time like a good little borrower. Almost $500,000 just in interest. It might be more than what you paid for the home. So mortgage math is like slow motion. And as long as the interest rates are hovering around the sixes, you are going to be paying more than double if you take a 30-year mortgage. So if you are in a position to be able to even consider a 15-year or 20-year loan, or to amateurize your payoff where you can pay it off in 15 or 20 years, it will save you tens of thousands of dollars, if not hundreds of thousands of dollars in interest over time. Now, the real beast, that credit card. I was just teaching a class on managing your money at one of our local government sites. They invited their employees from all of their different divisions to come in, and we talked about managing your money. And I had a few private conversations with some awesome people afterwards, and it just confirms the theme that I'm hearing and the conversations I'm having is credit cards are just taking over. All of a sudden you wake up one day and your $3,000 balance all of a sudden is like, how did I get $10,000 in debt on my credit card? Well, there's some potential conversations happening right now that I want to address. But before we talk policy, let's understand what's the norm right now. U.S. average credit card APRs are well over 20% and actually nearing 30%. Many people out there that are borrowing have over 30% APR on revolving debt. That means credit card debt. So let's use the example of $5,000 balance, and maybe you're at 28% APR. If you were trying to pay that off in about 2 years, do you know that that interest that you're paying on that $5,000 balance, it equals $1,480. And if you pay just the minimum on that $5,000, good luck. You are stuck in a cycle of interest forever. It will barely touch that balance, not make a dent, and you're just going to be paying to keep a balance paid out there for what? So what I want to share with you right now is a policy spotlight. See, a few days ago, I saw on social media that President Trump proposed a 10% APR cap on credit cards. My first thought was, how in the heck does a government official tell a publicly traded company what they can do with their money? That blows my mind. Could you imagine if some government official knocked on your door and said, hey, I know that you're charging $200 for this thing of yours, but we're going to require you to sell it for $100. What? I mean, the APR and fees, this is how the Capital Ones and the Discover cards and the American Express of the world make their money. They want us to pay high APRs. Is it fair? No. Is it illegal? No. But President Trump is calling for a 1-year cap on credit card interest at 10% APR starting on January 20th. Why January 20th? Well, that just happens to be his 1-year anniversary as president this term. So the goal? To ease the cost of borrowing on credit card debt that is crushing families. That means more of your monthly payment can go towards paying off the credit card balance. So here's the bright side. A typical household with a national average credit card balance might pay about half the interest that they do today, and this could potentially save hundreds of dollars each year, which can further go into the economy. It could pay off other debt. It can just go towards whatever you and your household needs. More of your payment pays towards the principal instead of interest. But, and this is where the math gets messy, credit markets run on risk pricing. What that means in layman terms, lenders charge higher APRs to offset the possibility of non-payment. So if you have a higher credit score, you're probably paying less in interest to reward you for it. If you have a lower credit score, you're probably paying more in interest because you are a bigger risk to that lender. What could go wrong? Well, this is going from this could help our households to this could hurt. So accounts could be closed or credit limits could be slashed by those creditors. See, analysts have suggested that up to 30 million Americans, especially those with weaker credit histories, they might see their credit line slashed or shut down under that 10% cap because lenders can't price their risk. They're going to say, hey, it's too much of a chance I'm taking on you to charge just 10%. And so I no longer want to do business with you and close your account. If your account is closed, now you have a really bad upside down debt utilization because you have a zero limit and whatever your credit card balance is, which by the way, they still expect for you to pay it. But what if you rely on the credit available on that credit card to pay for things like gas and groceries or just to help give a little margin in your family because maybe your expenses are slightly higher than your take-home income at the moment, and this is helping you get through. Secondly, credit becomes scarcer for people who need it the most. See, borrowers with lower credit scores, like students, people just getting started in the workplace, or people who are rebuilding their finances, they might lose access to credit entirely. And for them, this credit card is often the first line of defense in an emergency. Most people living paycheck to paycheck, if they experience an emergency, they have to put that on a credit card. They don't have hundreds of dollars sitting in their bank account to pay for it. Now, if traditional cards disappear for certain people, they don't suddenly become debt-free, right? If they can't access that credit card, they're going to go to payday loans, title loans, or maybe even go and borrow from, I don't know, somebody that they know, but maybe even with higher costs. So that's not relief. It's actually predatory economics dressed up as policy. So what do we do? You know, banks and credit card companies, they might charge other fees or cut rewards in order to make up revenue. These lenders might raise the annual fees. They might reduce, rewards and points that you get, or they might increase other charges, like for a late fee or exceeding your limit. So even if your APR gets capped at that 10%, the price could show up other ways, like charges from these companies. Is that right? Is it fair? I don't think so, but we can't also dictate how somebody else makes their money. And that's what the president is doing. I get the gesture. I just don't understand the approach. So what's the real cost of money? Whether it's a car loan, a mortgage, or credit card debt, the cost of money matters more than the monthly payment. It affects your savings and your stress and your financial future. Policies like this, insinuated 10% APR cap, it sounds amazing on the surface, but they can have ripple effects. Some good, like saving on the interest charges for the consumers, but some bad, where those lenders and creditors might limit or deny access to credit. Well, we can't fix what we don't understand. And we don't really know how this is going to affect us. I don't even know if it's going to go into play, but man, it's a big conversation in the credit card world right now. I just want you to know that the price of money is not just what you pay for something. It's what you pay for it over time. And I don't want you to have to pay $886,000 to get access to a $400,000 loan. There are ways to pay it expedited. There are ways to pay it off faster. And I've got over 150 episodes that dive into that to teach you more. So if this is the first time you're listening to me, welcome. You've got a lot to check out. But I want to leave you with this. If you are battling high APRs on your credit cards right now, call your credit card company and see if you can negotiate a lower APR, even if it's temporary. Maybe you could check out a transfer to a lower interest rate card. A lot of times they'll do a transfer for up to 18 months at a really low APR, introductory APR, or a 0%. The catch with this, my friends, is if you move it over there, if it's a low APR or a 0% for, say, 18 months, take that balance, divide it by 18, and make that as your monthly payment to pay it off in full. And then don't go use that other credit card and max it out. It's a trap. It just gets you deeper into debt. Learn through my other episodes how to improve your credit score. We don't have to complicate it. There are really simple steps to do so. And with a better credit score, you get better APRs. Hey, I want to say thank you so much for joining me for this episode. And if you'd like to learn more about your finances, check out my book on Amazon called Finish Financially Free. And until next time, my friends, stay well.
Subscribe now and share with a friend to stay in the loop for new credit content and insider tips to maximize your credit knowledge. And follow Credit Christie on Instagram.